Operating cash flow, often abbreviated as OCF, is one of those financial terms that can seem a bit daunting at first. But once you peel back the layers, it's really quite fascinating and essential for understanding a company's financial health. You might have heard of net profit, which gets a lot of the spotlight, but OCF is like the unsung hero behind the scenes. It's not just about how much money a company makes, it's about how well it can manage that money to keep the lights on, invest in future growth, and fulfill its obligations. So, what exactly is operating cash flow? At its core, OCF is a measure of how much cash a company generates from its day-to-day operations, excluding any cash flows that come from financing or investing activities. This makes it a critical indicator of a company's ability to sustain itself over the long haul. You see, profitability is important, but it doesn't tell you the whole story. A company can show a profit on paper, but still struggle to pay its bills if it's not generating enough cash from its core business activities. Let's break this down a bit. Operating cash flow is calculated using a few key components. First, you start with net income, which is the profit a company reports after all expenses are deducted. But here's where it gets interesting. Net income includes non-cash items like depreciation and amortization. These are accounting tricks that can inflate profit figures without reflecting actual cash flow. So, to get a true picture, we need to add back these non-cash expenses. Next, we have to consider changes in working capital. Working capital is essentially the difference between a company's current assets and current liabilities. If a company is increasing its inventory or has a lot of accounts receivable, it might look profitable. But if that cash isn't flowing in, it can lead to cash crunches. By adjusting for these changes, we can see how much cash is genuinely being generated from operations. Now, why does all this matter? Well, for investors, analysts, and business leaders, OCF provides crucial insights. A positive operating cash flow indicates that a company can cover its operating expenses, invest in growth opportunities, and return value to shareholders. It's a sign of financial health and sustainability. On the flip side, negative OCF can be a red flag, suggesting that a company might struggle to meet its short-term obligations or may need to rely on external financing, which can be risky. Think about it. Wouldn't you want to know if a company can pay its bills? If it can fund its operations without scrambling for cash? That's where OCF shines. It gives stakeholders a clearer view of a company's liquidity and operational efficiency. It's especially valuable in times of economic uncertainty when cash flow can make or break a business. Let's dive deeper into the components of operating cash flow. At the heart of it all is sales revenue, the cash generated from selling goods or services. This is the lifeblood of any business. But it's not just about making sales, it's about collecting cash from those sales. That's where accounts receivable come in. Efficiently managing accounts receivable ensures that cash flows in steadily, allowing the business to operate smoothly. Then we have outflows, which are the expenses that subtract from OCF. This includes the cost of goods sold, which covers the direct costs of producing goods. Operating expenses, like salaries, rent, and utilities, also play a significant role. These are the day-to-day costs that keep the business running. Understanding these outflows is crucial for managing cash flow effectively. So, how do we calculate operating cash flow? The formula is pretty straightforward. OCF equals net income plus non-cash expenses minus changes in working capital. This formula allows us to adjust the net income figure to reflect the actual cash generated by the business. It's a simple yet powerful way to assess financial health. Now, let's talk about the trends in OCF. Analyzing these trends over time can provide valuable insights into a company's operational efficiency. For instance, consistent positive OCF is a good sign, indicating that the company is generating cash reliably. On the other hand, a declining OCF trend might raise concerns about the company's ability to sustain its operations. Comparing OCF to industry standards is also essential. Different industries have varying capital requirements, So what looks like a healthy OCF in one sector might not be as impressive in another. Understanding these nuances can help investors and analysts make more informed decisions. But here's the catch. Relying solely on profit can lead to some pitfalls. Profit figures can be easily manipulated through accounting practices, leading to a distorted view of a company's financial position. Plus, profit doesn't account for cash flow timing, which can create discrepancies between reported profit and actual cash on hand. In the end, operating cash flow is more than just a financial metric. It's a vital tool for assessing a company's economic vitality. It offers a clearer picture of cash generation from core business activities, allowing stakeholders to make informed decisions about a company's financial stability and long-term potential. So, the next time you hear about a company's financial performance, remember to look beyond the profit figures and dig into that operating cash flow. It just might tell you a more compelling story about a company's true financial health and its ability to thrive in the ever-changing business landscape.